This is Asia Trade. I'm Shery in Tokyo. The top stories this hour. Asian and U.S. stock futures pointing higher with Brent crude below $100 per barrel. President Trump says negotiations to reopen the Strait of Hormuz are proceeding nicely. But Iranian media report attacks on their ships in Hormuz with loud explosions heard near cities on the strait. And Japan's prime minister says a $19 billion supplementary budget will not mean extra bond sales as she moves to ease market concerns.
I'm Haidi Stroud-Watts in Sydney. Let's take a look at the setup for trading across Asia as we continue to monitor these geopolitical progressions, as well as the impact, of course, on oil being front and center still. But take a look at how we're setting up when it comes to Japan and Korea markets. As we had, as Shery mentioned, S&P futures looking higher by 0.8%, holding these gains. Kind of little change compared to Monday's session, but still sharply higher from Friday's situation. This sort of ongoing optimism that we are seeing progress when it comes to the diplomatic talks between the US and Iran. WTI, we'll get to that in just a bit, but also not too much of a strong move there. But taking a look at what we're setting up for, perhaps a little bit of downside there when it comes to Kospi futures. We've got a little bit of that labour union development, but mostly in a group that doesn't involve a lot of those chip employees. For Japan, Nikkei futures are looking like we'll pop again. The topics in the Nikkei 225 really accelerating these rallies, with each hitting record highs in the intraday session in the previous session. So we will be seeing if that momentum can be sustained, with the Nikkei futures up by 3.25%. Dollar yen is at that 158 handle. We've seen the dollar retreating broadly within that G10 as some of that geopolitical optimism towards a negotiated deal starts to rise. Let's switch out the boards and take a look at, of course, oil as we continue to watch the impact on crude. The declines, given the opacity perhaps of that US-Iran outlook, there's an argument that we've seen a little bit sort of too much of a fall too fast, if you will, but still holding that decline. Traders seeing that progress towards a deal. Gold is seeing a little bit of upside, about 0.1%. We're seeing Sydney futures looking like we're on track for a fourth straight day of gains. Shery.
So let's delve into our top story, Haidi. President Trump saying that negotiations with Iran over a deal to reopen the Strait of Hormuz are proceeding nicely. But in the past couple of hours, Iranian media have reported now that U.S.-Israeli strikes have targeted Iranian vessels in the strait, with loud explosions heard near coastal cities. Let's bring in Stephen Sapchinsky, who leads our Asia energy coverage and joins me in the Tokyo studio right now. So when traders are looking at everything that's happening, and as Haidi mentioned, the opacity of these negotiations, what could drive the move higher or lower from here?
I think if you hear the word progress, if you hear officials saying that you're close to a deal, we've seen that. You've seen WTI and Brent both sell off because of that. I think that there is a general fear that this could unwind and then go back to attacks in the region. If there are strikes on Iran, then what does that mean for the wider region? Could Iran do retaliatory strikes on Saudi Arabia, Qatar, the UAE? That's the fear. So as long as they're still in this game where they're moving forward, where they're still engaging each other, I think the market generally expects that things will continue to sell off. And that's what traders have been telling me. Now, there is also the situation of Hormuz, which effectively remains shut, choking supply. But they are pricing in a relatively quick ceasefire and deal to come through, which is pretty interesting.
And they're pricing in the fact that potentially oil supplies will rise exponentially, but that might not necessarily be the case.
Exactly. So it's quite complicated, actually. So even, over the last few days, you've seen some ships get through, even though there hasn't been a ceasefire. You've seen 3 LNG tankers go through in the last few days. Iran says that 33 vessels went through on one day, which would have been the highest level since before the war began. But still, it's not near the 135 vessels that were going through on a daily basis. Now, okay, you open up the strait, there's a peace deal, right? There are so many complications around that. Are all of the oil and gas exporters willing to send through? Are they sure that there aren't any still risks? Are they sure that there won't be some sort of setback between the U.S. and Iran? Are the ship owners willing to put their ships through? Are the seafarers on the ships willing to go through? There are so many different pieces of this puzzle. So getting back to the pre-war levels, it's not going to happen overnight. And it almost seems like the oil market does expect at least a quick opening.
Just the fact that you're saying it's safe to go through doesn't necessarily mean that everybody will feel safe, right? What about shipping fees that Iran wants, supposedly for services and environmental protection?
I mean, well, that's been one of the sticking points that Tehran has really kind of held on to. And I think it's something, especially over the last 3 months that there's been this war, they've had control over this strait to a degree that we've never seen before. And the new government, do they want to let that go? Do they want to get rid of that bargaining chip, especially in the future where it's unclear if they still have allies in the region? So that's something that they're going to push for. The Trump administration has said that they do not want that, and Trump has been very vocal about it. And let's say theoretically somehow there is a deal and Tehran, there is some sort of toll or something that ship owners have to pay. That becomes a complicated matter because maybe for some companies, okay, they pay it, they go through. But for others, they're not going to pay a sanctioned regime. You know, for big oil and gas companies, especially Western ones, they have a risk department that deals with this. The lawyers will not let this happen. The banks involved won't let it happen. So that just adds another level of complexity.
Leads our Asia energy coverage. They're in Tokyo today. Let's take a look at the market impact in a little bit more detail. Bloomberg's Anthony Stevens joins us now from Hong Kong. So still a lot of uncertainty, opacity, volatility when it comes to whether or not we get this deal and what it looks like. What are we seeing as the leads when it comes to the Asia Open today?
Yeah, the cross-asset leads are actually interesting, right? We start to see FX follow equities in caring a little bit less about the geopolitical picture. So yesterday, after we went home in Asia after an extremely strong session, Europe kind of picked up the baton and ran with it, right? European volatility is now on FX and equity is now lower than pre-war levels. So Europe is obviously a very energy exposed area of the world. And if they can start to price out kind of the impact of oil, I think Asia will take a lot of comfort from that coming into today. There was some thinly traded ETFs in Asia, on Asian equities in Europe that were also quite strong. So there's plenty of follow-through momentum into Asia. And I just want to touch on that quickly, the concept of momentum. The gap between momentum and everything else in Asia is starting to widen massively. So traders are really getting paid to stay on the themes that are working. And that's chips, that's tech, that's robotics. The gap is almost like 30% now in chasing momentum versus staying with kind of existing benchmarks. So that is a big lead coming into today, especially with Korea, where the market is, notoriously momentum chasing. So Korea has a lot of positive leads coming into its reopen today.
I suppose the question is whether that tech-driven momentum can continue.
Yeah, look, the incremental headlines around the hard tech also continues to improve. So you had Yaskawa Electronics yesterday talk about their robotics business being very strong. Hyundai coming into today is talking about cordoning off their robotics business to give it more focus. And then Shanghai Unitary is pushing for a starboard IPO as soon as possible. So there's a lot of momentum on the robotics side of things, which is the next leg to the tech rally. You've seen stuff like LG Electronics and Hyundai do really well. And on the tech side, after we went home, the China's chip stocks went limit up in China. So there's plenty of regional tech momentum from technological developments. And that is where I think, the investors get a lot of comfort that this rally is being driven by incremental technology improvement headlines rather than the back and forth on macroeconomics. As long as that dynamic continues to be in play, especially with the big US IPOs coming up, that will support the tech rally.
We saw the dollar, Anthony, weaken against every G10 peer in the overnight session, right? How much is that going to benefit? I suppose you'd want to look at whether that's sort of sustained respite for the yen in particular.
Look, I think FX is where, the rubber meets the road with the oil crisis, right? You saw EM FX really have a sigh of relief yesterday, was up about 30 bips across the board. And Korea will be a big part of that, something to watch today as the Korean won has been under pressure for quite some time. So will they have a kind of move similar to what India had yesterday with the Indian rupee rallying around 39 basis points? These are pretty small moves in the context of the equity rally, but perhaps on a human level, worth watching much more. To return to your question on the yen, look, it's been very, very stable in and around the 159 level, and there was no need for intervention yesterday. Now, with the dollar pulling back, it'll be very interesting to see whether the yen actually strengthens materially. The yen is in a bit of a weird place, right? Because as risk improves, the yen weakens. So it's caught between relief from the oil kind of crisis, but again, weakness driven by equity inflows.
Bloomberg Markets reporter Anthony Stevens ahead of the Asia trading day. We're still ahead on the Asia trade. Japan says it'll fund a $19 billion supplementary budget without issuing extra bonds as the government tries to ease market concerns. Details are next. This is Bloomberg.
Japan's prime minister says her government will finance its supplementary budget without increasing bond issuance on a calendar basis. Sanae Takaichi is preparing to submit the $19 billion package to parliament as early as next week. Let's bring in our Japan economics and government reporter Yoshiaki Nohara. Yoshi, I guess at least when it comes to this extra budget, it does improve the optics for investors that she's not going to issue more bonds. What does that mean for the economy?
Right. So it's good for the economy in terms of supporting the households by removing some anxiety over higher energy costs, utility bills. But at the same time, it's negative for inflation because, subsidies would mean that artificially readings about the inflation will be lowered somewhat.
The fact that she had to push this supplementary budget, the fact that she had to shift her stance, what does this tell us about her leadership style and what we can expect in the next few months?
So, Shery, that's a really good question. So one thing it was very clear from the way she delivered the announcement yesterday was that she wants to be seen taking action directly for the public. But at the same time, to me, it sounded like she was talking to the bond market directly. So she was very conscious about how the market perceived her plan. And therefore, she emphasized that this plan is not going to require boost in the issuance of bonds on a calendar basis. That was a conscious, the framing that she had for her announcement.
At the same time, of course, given the necessity for the economy, for further support, especially for households, what are we expecting next from her administration?
Well, I think that she also recognized that the government cannot subsidize everything. So meaning that she will be, under the pressure as long as the situation in Middle East is going to be volatile. She will remain under pressure. What she can do more to ease anxiety for the households, and that has to be a political challenge for her because she has to keep the public happy, even though the election is not happening this year. She got huge mandate because of the big election win, and she knows that where her support is coming from.
Yoshiaki Nohara there with the latest on Japan. Bloomberg Japan economics and government reporter breaking down, of course, the extra budget that we're expecting. Also, Philippine President Ferdinand Marcos Jr. now here in Japan this week for a 4-day state visit where he's expected to meet Prime Minister Takaichi and also Emperor Naruhito. Bloomberg's East Asia government editor John Herskovitz joins us with more on this. And a very crucial meeting at a time, of course, when the entire region is dealing with the Iran war and the energy crisis.
Exactly. I mean, the meeting will have its pageantry. There's going to be the meeting with the emperor, as you mentioned, and the signing of deals. But the whole thing is security, energy cooperation. Japan and the Philippines are probably the closest security partners around in the region. And it's like, how are they going to manage relations? They're both facing difficulties with China over territorial issues. They're both key allies of the U.S. who have worried about their relationship with Washington as things have changed. And they're both seeing a drawdown of U.S. military equipment in the region, which is going to help the U.S. in its fight against Iran.
Tell us a little bit about that very tricky diplomatic relationship. As you said, both countries have these challenges with China at a time when they want to be close allies to the U.S., but that is also having some issues.
Exactly. It's like both have key trade relations with China, which they want to protect. They also have the relations with the U.S., and Trump has questioned some of these traditional alliances, whether it's in Asia, whether it's in Europe. Japan and the Philippines are some of the oldest around. Japan and the Philippines have also been working together. Earlier this month, for the first time since World War II, Japan participated on the ground in military exercises in the Philippines. The Philippines is also looking to procure equipment from Japan as it tries to boost sales of its defense sector. So the cooperation is there. The challenges are there for both of them, and seeing if they can get on the same page is in the interest of both as they look at a different relation with China and a different relation with the U.S.
And of course, both countries, we were talking about the extra budget here in Japan. The Philippines has its own domestic issues with the impeachment of the Vice President Duterte. How challenging has it been to prioritize the security relationship between the two sides when they have so much going on?
Yeah, I think this may be actually one of the easier things, because the turbulence in the Philippines, in the Philippine politics, is always turbulent to begin with. Takaichi is facing these budgetary challenges, the worries from investors of the issuance of new bonds, what's going to happen with debt, and we're seeing yields on Japanese bonds going to levels which haven't been reached for decades, since the 1990s. So they have the turbulence on the political side at home, but this relationship on security has been pretty stable through a lot of years. So this may be something which both the leaders can find common ground as they have their difficulties at home.
When we look ahead and we have the Iran war ongoing, what will be next for these two economies and administrations?
Yeah, it's just energy security is one of the key issues. The longer the war goes on, the more difficult it is to procure supplies from the Persian Gulf, from the region. Both are heavily dependent on exports from this region. Also, keeping supplies of oil, and also just how they manage their economies as resources are becoming tighter and they're facing domestic constraints.
John Herskovitz, really good to have you break down, of course, the visit by the Philippine president to Japan this week. Bloomberg's East Asia government editor there. We have more ahead on the Asia trade. This is Bloomberg.
The top global headlines that we're following this hour. Russia has advised the U.S. to evacuate its citizens and diplomats from Ukraine's capital. The Interfax news agency says Foreign Minister Sergei Lavrov told Secretary of State Marco Rubio by phone that Russia is launching systematic and consistent strikes on Kyiv. Moscow frames its drone and missile barrage as retaliation for a Ukrainian attack on a college in the Russian-occupied Luhansk region. The number of confirmed Ebola deaths in the Democratic Republic of Congo has now topped 200, raising fears of a wider regional spread. Response efforts are struggling in a volatile region with weak health systems and attacks on treatment centres slowing containment. African officials say global pledges of help have reached about $500 million, more than double the amount just last week. The Vatican is joining the growing debate over AI regulation. Pope Leo has called for artificial intelligence to be disarmed, warning that it could pose risks to humanity. The Roman Catholic leader also wants AI to be more human-focused and less controlled by powerful tech monopolies. The calls maybe put the Pope at odds with President Trump, who backs AI deregulation. Let's take a look at how we're setting up as we get Tuesday trading almost underway here in Asia. Looking like a pretty optimistic start, with US equity futures holding on to those gains amidst this ongoing general sense of optimism that we are seeing some bits of progress when it comes to the US-Iran diplomatic negotiation situation. We are seeing crude a touch firmer in the morning, though, but there were some reports of explosions from Iranian media around the Strait of Hormuz. Prices are still pretty down sharply compared to Friday's close. those as well. We are seeing Sydney futures looking like we're setting up for a fourth straight day of gains, despite a lot more muted in this part of the world, given that sort of heavyweights of energy and LNG names trading here in Sydney versus, of course, the tech rally. But we are also seeing some strength for the Aussie and the Kiwi dollars as well, with that pullback in the dollar and that resumption of risk-taking within the FX space. Nikkei futures looking like that momentum that we see behind Japanese stocks will continue. We're seeing S&P futures there up about 0.7%. But take a look at the picture when it comes to oil, because it is a sense of just waiting for what that next development will be when it comes to US and Iran, but mostly holding on to that decline though. You've got New York traded crude about 6% lower intraday, signs that these negotiations will extend as the ceasefire continues and the potential reopening of the Strait of Hormuz making progress there. President Trump did say that these talks were progressing nicely, but we did also see, on the other hand, some signs of hostilities remaining with those reports of loud explosions near the Iran's coastal cities, I should say. We're seeing iron ore holding a little bit low, about 0.3%, but gold putting on about 0.1%, Shery.
Yeah, Heidi, and yet we have seen that Hormuz optimism really carry the markets across the world, right? The global risk on, and perhaps something that we continue to see in the Forex space, because we have seen emerging market currencies also gain ground for the past 4 sessions. We have seen that safe haven demand around the dollar narrative also fall. So actually the USD has been down against most G10 currencies, and we're seeing it pretty steady in the early Asian session as well. In fact, even the Japanese yen managed to strengthen against the greenback, and we're holding just below that 159 level against the US dollar. And you can see the euro also holding at that 116 level, and the offshore yuan is one to watch. Not a lot of movement right now, but after rising to the highest level since 2023. Of course, in China, we do have a separate story, which is not only just dollar weakness, but also capital control narratives in China that are also supporting the Chinese currency. And the Japanese yen, I gotta say, do watch out for anything to do with JGBs. Take a look at how we're setting up with the assets ahead of the Japanese market opens, because we're watching the JGB rally that we saw earlier in the week. And this is after we actually saw the 10-year yield reach the highest level since the 1990s. And remember, this was around concerns about where Japan goes when it comes to fiscal risks. Of course, we do have the oil situation, the concerns around inflation. What will the Bank of Japan do in its June policy decision? But at the same time, it's been the idea and the skepticism on whether Prime Minister Takaichi's new extra budget will mean that she will have to issue new bonds. Now, she's come out and said she will not be issuing new bonds, at least on a calendar year basis. So we have seen JGB's rally. We'll continue to watch that story very closely at a time when also what's interesting across Asia, in Japan, do watch out for those tech names, do watch out for those semiconductor names, because it's also the robotics story that is playing really hard across Northeast Asia, especially in South Korea, right? I mean, we have seen the incredible rally of the Kospi. We're talking about the world's best performing market, also one of the most volatile markets. This week, we'll be watching the conversations with Samsung, but also it is that rally around the robotics theme, around the tech theme, semiconductors, that has sent Hyundai Motor higher, and Hyundai Motor has really popped. Remember, it has a partnership with Boston Dynamics. They're creating really cutting-edge technology around robotics. So do watch out for these stocks across Asia that has seen a massive rally, really outperforming the broader markets. We have more ahead on the Asia trade. This is Bloomberg. Heidi, we might be seeing some more momentum in the Iran-U.S. negotiations. Of course, this to do with President Trump now talking about how negotiations to extend the ceasefire and reopen the Strait of Hormuz are supposedly proceeding nicely. At least the market seem to agree with him. We have seen the optimism around the Strait of Hormuz. But at the same time, we always have to really take everything with a grain of salt, right? We've been fooled so many times in the past when we thought we were very close to a deal for that not to happen. And the fact that we are now hearing reports from Iranian media about loud explosions near coastal cities and what's happening in the Strait of Hormuz still leaves big questions about where we're going with these negotiations.
The question, Shery, is whether this momentum in the markets that's really being almost entirely driven by the AI enthusiasm, the tech rally, the chip rally, very heavily concentrated in these specific segments of certain markets. Sorry, I'm talking about Korea, Taiwan, Japan catching up to a certain extent, China starting to get involved as well. Whether that's going to be enough of that momentum to continue driving that broader rally. At the same time, though, we are seeing that, as you say, the repricing in crude markets have been quite interesting. Some would say perhaps a little bit overdone. We are down when it comes to that intraday trading for New York traded crude by almost 6%. We're holding pretty close to the lows of the last few days. And the question is, given the opacity over these US-Iran negotiations, whether we might see some more volatility yet in energy markets. At the moment, though, we're seeing US futures looking pretty optimistic at the moment. And the Nikkei 225, we're 30 minutes out from the start of trading across Japan and Korea coming back online as well, up about 0.1% trading in Singapore. At the same time, though, we know that a number of Asian countries, India is amongst them, that have really seen that outsized impact from the crude, the oil price crisis. And we are seeing top diplomats from some of these nations, including Australia, Japan, the US, in New Delhi today for a meeting of the Quad Group. India's foreign ministry says the meeting will tackle regional developments and international issues of mutual concern. Let's get more on the expectations for these discussions with Shruti Pandalai, who's India chair at the Lowy Institute. Really great to have you with us here in Sydney. What's at the top of the priority? Because at a number of these multilateral platforms and events, we have seen Iran as being front and centre and the broader economic repercussions for the rest of the world.
Thanks very much for having me. You're absolutely spot on. Like your report highlighted, the Iran crisis really is going to be the singular important agenda item of the Quad. For India especially, when the crisis escalated, you saw India suffered because it lost Iranian oil. Also, the waiver on Russian oil went off. So it was a squeeze doubly, and India sort of gets 3 million barrels a day from Iran at that point of time. So that's going to be up front and center. If you look at the neighborhood, Pakistan, Bangladesh, a lot of countries in South Asia already feeling the squeeze, saying they have just 1 month of reserve. And guess who stepped in? China, to fill that vacuum. So I think the 4 Quad countries with their convergence around China, this will be on top agenda item. Second would be, I think, in terms of, reassurance to folks living in the Indo-Pacific countries watching what has been the shadow of the Trump-Xi summit, where sort of the impression really where many countries would have come off is that America sort of accepted China's formulation of a G2 architecture. Where does that really take countries who've been trying to create alternative options, whether it's supply chain, tech resilience, manufacturing, so on and so forth. I think that's, again, the Quad worked because there was a public goods component to it. And I think that's, how do you, the Quad survive the stress test and sort of deliver on these tangible options in terms of technology resilience, supply chain. All of these priorities will be very high up on the table.
Yeah, that's very interesting that you talk about kind of what the perception was coming away from Trump-Xi in Beijing just a couple of weeks ago, right? What sort of deliverables do you expect to see from this set of negotiations?
I think the energy crisis has become the larger sort of troubling issue for the Indo-Pacific. So I think the energy crisis, how do we diversify? How do we come together? Australia, Japan, India and the US, the diversification and the requirement for energy reads will definitely be up and center. Two, creating deliverables, as I said, on the China factor, whether it's critical minerals, whether it is maritime domain awareness, awareness. The Quad has seen wins already in terms of habits of cooperation on the defense cooperation piece. So I think that will have a further discussion. Working groups have been ticking, whether the political momentum has been waxing and waning, especially on the India-US front. India really had taken ownership of the Quad process, but as you are aware, the last 2 years, the rose-tinted glasses have come off on the US relationship in India. And I think going forward, there'll be a lot more pragmatism, that you might not agree on everything, but especially on the Quad deliverables and Indo-Pacific reassurance, all 4 countries will come together.
My question, though, is sort of the relevance. You say the importance is obviously there. The relevance is arguable, though, because we haven't had a leaders' meeting since, 2024. We know that President Trump doesn't, give assign a lot of importance to the Quad. Does it make it more difficult for agreement and longer-lasting policy to be set then?
Well, I'll give you a statistic. Penny Wong is meeting her Indian counterpart, Dr. S. Jaishankar, for the 28th time. Motegi's turned down and sort of gone on record to say, well, the Quad remains relevant because the challenges haven't gone away. We have to talk economic security. We have to talk critical minerals. Yes, a leadership summit and a leaders summit would be desirable, but that's not stopped the Quad from ticking. I think the less glamorous bits of it, where the working groups really work, whether it's the cancer and the vaccine shots, the health sort of development, where Quad partner countries have come together in, disaster response, whether it's in the Pacific, whether it's in Southeast Asia. These are real tangibles that the worst sort of skeptics of the Quad really eventually converted into champions for it. So I do think that, while the debate on the relevance is slightly, I think, a battle of perceptions, if you will, I think the Quad, the proof of concept in the Quad will be the deliverables that come out in the next year. We've already seen tangibles in terms of maritime security cooperation, real things like, having maritime domain awareness initiative, which exchanges information on what is seen as Chinese unilateralism in common waters. So these are real tangible threats. Climate, HADR, I mean, these are the places where the positive agenda, where the containment of China is not highlighted, but the actual tangible alternative deliverable in terms of supply chains between Japan, Australia and India can produce those results. I think it's about heads of state and their principals in terms of foreign ministers actually putting their heads together and pushing some of these pilot projects out as, real, tangible, successful wins.
Shruti, what about containment of Russia? I mean, we have seen the friction point with Russian oil, especially between India and the U.S. and the tariffs that the U.S. has applied on India. How much progress has there been on that front, and are there any more challenges? Also, not between just U.S. and India, but within the Quad grouping.
I think, for New Delhi, the India-Russia relationship is a legacy relationship, and that's where the strategic autonomy concept of India sort of kicks in. India's relationship with Russia is more than energy. We have 2 live borders on the west and the east, and real sort of lived, that's the very lived reality that New Delhi lives in. So Russia does play an important role in the defense preparedness, because in terms of military hardware, inventory, even though there's been a real tangible diversification of India's relationships, I think a component of that in terms of a legacy relationship still stays. I think the win for the Quad partners, has been a real-time understanding and congruence of the real challenge, which is all 4 countries believe that the China challenge has not gone away. They have been able to compartmentalize and assuage concerns on both sides on what they see as acceptables and non-acceptables. And I think the Quad's biggest success story has been strategic alignment, because all 4 principles come together and sort of discuss this in great depth. I think you will see Marco Rubio giving a great behind-the-scene assessment on the Trump-G summit, because for most countries in the room, the big question of the grand bargain with China will be up front and center. Everyone will not want to know about whether the U.S. will abandon the Quad or not. What does that mean for the various threat perceptions, whether it's coming from Russia or for China, for partners in the room? But really going forward, can there be U.S. predictability and more sort of depth in all the bilateral partnerships to keep the defense cooperation framework that was so robust and had taken 20 years to build, if you will, continue to deliver those tangible results. I think those are the conversations that we'll see more and more. And I think some of the conversations on Russia, which have already seen sort of a strategic convergence come through, won't really be that high up on the agenda.
So, Shruti, we have seen India, of course, weakened by the war in Iran and its reliance on imported oil. But at the same time, the power of Prime Minister Modi seems to have gone up as a one-party state sort of situation after the elections in West Bengal. How much really dominance does he have over domestic politics to be able to project this on the international stage?
I think Prime Minister Modi and his party have sort of, as you said, have seen a sort of great number of wins in the domestic political election cycles. And I think that does add more power and credibility in the parliamentarian system that India follows. Having said that, India has also risen both in its economic and diplomatic heft. I'm quoting from Marco Rubio's statement yesterday, where he talks about the necessity of the India and US to come together and make sure the comprehensive strategic partnership delivers not just bilaterally but for the region, and also acknowledging India's global influence. Because if you look at Prime Minister Modi's diplomatic calendar since January this year, the Indian ecosystem's diplomatic calendar since January this year, there have been summits and meetings in Europe, and which delivered, of course, came at the after the Europe-India FTA agreement. You've seen investments and outreach in Latin America. You've seen West Asian diplomacy achieve heightened sort of pace and importance in the Indian establishment. You've also seen a lot of work going into Africa, and later on this year, Prime Minister Modi is going to be on tri-nation visit, which ends up in Australia, reportedly. So I think, you know, the level of Indian engagement, its ability to sort of be the bridge between the North and the South, East and West globally, and the fact that there are real tangible options that India brings to the table in terms of overseas development assistance, in terms of its technology capabilities, its AI ecosystem, its healthcare, and basically the deliverance of public good outside of the defense cooperation and the capacity and capability building that its outreach sort of highlights. I think that's a package that is only going to see more and more momentum as you go forward.
Very quickly, do you expect Taiwan to come up?
Well, I think a lot of, I'm sure there'll be a Taiwan discussion given that the shadow of the Trump-Xi summit and some of the perceptions that came off that meeting. But I think the US has already sort of conveyed to its partners alike that the China challenge remains up center. I think what we've seen, especially from DC, a lot of the commentary that comes in is that while this might be a strategic stability exercise, the deep-rooted hawkishness in the system on China stays. So I'm sure that'll be on the table, but I do think Iran and the energy crisis will be on the top of the agenda.
Shruti, really great to have you with us. Shruti Pandalai, who's the India chair at the Lowy Institute. Still ahead on the Asia trade, the world's biggest housing bubble has popped. That's New Zealand, exposing the economy's dependence on rising real estate values. We have more coming up in the day's Big Take. This is Bloomberg. Well, New Zealand is experiencing a prolonged downturn in its housing market. The median house price falling 16% from its 2021 peak. That's exposing the country's economic dependence on over-rising home values. That's bringing Bloomberg's economist James McIntyre for more. This is sounding very familiar, a little bit closer to home too. But what's going on in New Zealand?
Yeah, so what's happened is that, well, it's not just the housing market. New Zealand's actually been through a prolonged recession over the last couple of years. And we've seen with monetary policy really being tightened dramatically, taking that sledgehammer to crack that inflation nut, has sent the economy backwards. And for an interest rate responsive sector like the residential construction sector, that's had a very big impact. At the same time, governments in New Zealand, especially at the local level, have been doing what governments, say, in Australia and a lot of the Anglosphere would love to do, and that is opening up housing supply. And so there's been a major construction supply response coming through with an alleviation of regulations. So if you have a recession, a downturn, unemployment rate, crimping demand, a little bit of a weak economy domestically and a strong economy in Australia, sending Kiwis offshore, then all of a sudden a supply side response comes on. Weak demand, strong supply, and here we've got that prolonged price downturn as a result.
I guess the question is, can you address affordability and accessibility without the erosion of accumulated wealth? Asking for Australia as well.
Well, this is the challenge. So Australia has this affordability challenge. A few other countries around the world have, and as a government, you're trying to thread the needle. You're trying to make sure that asset prices continue to grow a bit, but wages grow a little bit faster, so affordability improves. But it's the other instrument is monetary policy. But if you have an inflation challenge, those higher interest rates make housing unaffordable. So are you going to get the wage response to help first home buyers and others afford the higher interest rates to keep those asset values where they are? Well, not if you want to keep inflation pressures in check. So this is where we are. And when it comes to the New Zealand side of things, we've had that weak labour market, that recession, policy induced, lingered on for longer thanks to some tight fiscal policy, and a very, very big supply response meant that here we are 4 years later, and house prices are still below their peak. And if we think about that after the inflation surge we've had, in real terms, house prices have retreated quite some way.
When we spoke to the RBA Sarah Hunter last week, she said obviously the goal is redistribution, right, rather than a very steep come down. Are you confident that can be done?
Well, we've seen the measures that the government's announced in the budget around dealing with tax concessions for negative gearing, so investors helping with subsidise the running costs of them owning loss-making properties or properties where the expenses exceed the rent being the rent that's returned, and then the capital gains tax. But what that change to negative gearing has done is that lenders are having to take that into account in how much they're prepared to provide investors to purchase those assets, and it's really pulled them back. And it's meant that now we've got a much, much more level playing field when it comes to first home buyers and other owner occupiers versus investors who were getting a little bit of a help, a little bit of a leg up from those tax concessions. So we've pulled that back. It now is a bit more of a level, even playing field. We'll see if first home buyers are able to step forward in that, given those settings.
Bloomberg's economist James McIntyre there. Subscribers can get more on the New Zealand downturn, exposing housing trade-offs in today's Big Takes. Terminal clients can find that function at NI Big Take. It's also available on Bloomberg.com. And Shery, I don't know about Japan or, of course, in Hong Kong, where we both used to live as well, but I've never lived in a place like Sydney in terms of how much housing prices, property listings, Saturday morning auctions are basically a national obsession, right? And it's very interesting, as James alluded to, we're starting to see some of these policy levers being taken out of the budget. But even prior to that, with the start of the tightening cycle from the RBA, we did start to see really that cooling when it comes to the property market. It is also seasonally a quieter time, but take a look at where we're coming from, right? In Sydney, the average home costs almost 14 times annual disposable income. This is the world's second most expensive city to buy property after Hong Kong, according to data in 2024. The latest CoreLogic numbers, the median property price in Sydney near a record high of 1.3 million Australian dollars. In some suburbs, I look at some of the houses adjacent to near the office, for example, in sort of the inner city eastern suburbs, you are seeing dilapidated terrace houses that will require at least $1 million to renovate, and they're selling for over $2 million easily, even before auction.
I'm surprised that New York is not in that list. I mean, having lived in New York and coming from Manhattan, that was painful. But I gotta say, here in Japan, in Tokyo, it's been relatively easy, and perhaps it's also because I'm renting. But when it comes to used condominiums, for example, prices have stalled in the last 2 months or so. It's come back a little bit again. And we're talking about record highs again, which is a very interesting dynamic that we're seeing in Japan, because the property market in Japan wasn't doing anything for decades, right? At a time when the BOJ and rates were nowhere for years. And it started getting that boost in the last couple of years. So when we're talking about used condominium prices in central Tokyo, they managed to rise in April. And Tokyo Kante Research is now saying that we are seeing prices at around $1.2 million for a unit that's around 70 square meters. And when it comes to actually house prices, existing house prices, we have seen them rise for 8 months. More ahead, this is Bloomberg. South Korea markets set to reopen in a few minutes after a holiday on Monday. Let's check what investors should be watching and bring in Asia equities reporter Yu Lee. And Yu, I mean, we're now expecting this new leveraged ETFs on Samsung and SK Hynix to launch at a time when the Kospi, the South Korean equity markets, are not just the best performing in the world, but very, very volatile as well. What will this do to the markets?
Yeah, absolutely. So South Korea is launching for the first time single stock leverage ETF, which were previously banned because of the risk control. But now the authorities are for the first time allowing single stock leverage ETF, and they are starting with Samsung and SK Hynix, which will make their debut listing tomorrow. So this is definitely going to add more volatility. Market participants are expecting blockbuster demand for this new single stock leverage ETFs on Samsung and SK Hynix. And even before the launch of this leverage ETF, which can magnify gains but also amplify losses, South Korean market has seen really big swings. It's been increasingly common to see intraday swings of more than 5% if you look at the Kospi's May performance. And because of the nature of the leverage ETF, this is definitely going to add more volatility.
Yu, super quickly, what else should investors be watching this week?
So this week, Thursday, BOK rate decision, which will be the first time for the new governor to hold a rate decision. So we're expecting some kind of a hawkish tilt. That's going to be the key event, in addition to some of the National Growth Fund that's been giving a lot of boost to the small cap Kosdaq space. So I'll definitely watch the small cap space this week, which has been outperforming Kospi.
Yu Lee, thank you so much, Bloomberg Asia equities reporter. As we await the market opens in Seoul, Sydney, and Tokyo next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens. As we have seen that global risk-on rally, Haidi, of course, U.S. cash markets have been closed. But at the same time, the risk-on rally continues as we're seeing oil fall on optimism, perhaps, that we might see negotiations for the ceasefire between the U.S. and Iran succeed.
At least as far as tech investors and investors watching the AI rally and wanting a piece of that are concerned, it feels like geopolitics, the war in Iran has been yesterday's news for weeks now, right? That momentum just continues being built when it comes to this particular part of the market in these very specific geographic markets. The question, I guess, Shery, is whether that can continue to be sustained as we still have a great deal of uncertainty over what happens with this more enduring truce.
We'll be watching what happens with those negotiations at a time when we are seeing a little bit more upside in Japanese stocks early in the session, perhaps a little bit of divergence with the topics, which is a little bit under pressure. But the Japanese, again, holding at that 158 level against the U.S. dollar. We have seen a little bit of strength on the overnight session as well, as we're seeing the U.S. dollar pretty flat. Of course, we have seen U.S. markets away, so liquidity might be a little bit flat. But what we'll be watching also is the JGB space in Japan, especially with the 10-year yield still hovering around highs that we haven't seen since 1996. But we actually had a little bit of a rally on JGBs, given Prime Minister Takaichi coming out with her new extra budget, but at the same time saying that there will be no more new bond issuance on a calendar basis, at least. Take a look at how South Korea is also opening. Of course, we've talked about the tech trade. We'll be watching those robotics names. I've seen a lot of momentum lately, and we're watching the Korean won, which is still a little bit weak against the U.S. dollar, past that 1,500 level. And of course, the ongoing labor conversations in Samsung continue to be in focus, but we're seeing that broad upside early in the session for Kospi right now, Haidi.
Broad upside being seen when it comes to what we're seeing with treasuries at the moment as well. In fact, at the moment, we're seeing treasuries rallying across the curve on this speculation and optimism that potentially we see really this deal being done, right? Despite, of course, not a great deal of detail. We had President Trump saying that it's sort of coming along, if you will. But the frenetic trading when it comes to the treasury and the global bond sell-off has certainly taken a step back. But this is what we're watching when it comes to oil as well. We're seeing now Brent crude seeing that upside of close to 2% at this point. This, as previously was oil holding sort of that drop on these hopefulness that the negotiations will be extended into a more enduring sense of peace, if you will. We're also continuing to see the upside when it comes to European gas futures. That really is a supply-demand side situation there as well. They are trading higher by just about 1%. We did see a little bit of a drop in the previous sessions, again, on that progress, but that started to pick back up there as well. And as I mentioned, we are watching treasuries at the moment as we see a pretty broad-based rally across that curve. Let's bring in Shery, our next guest, for a little bit more on what we should be watching given how uncertain these markets remain.
Yeah, Vasu Menon, Managing Director of Investment Strategy at OCBC, joining us now. And Vasu, I mean, we talked about this global risk on rally, but of course, as Haidi mentioned, the uncertainty is still there on what happens with Iran, right? So where do we go from here?
Well, you know, in the last month, a month and a half, we've actually turned more positive on equities. I mean, we saw the correction as an opportunity for investors to accumulate. And I guess, you know, the market's price action has validated our call. Global equities were down 10% in March after the US and Israel attacked Iran, but they've rebounded 16% based on the MSCI All-Country World Index. And we see potentially more upside. Of course, Iran, what's happening in the Middle East remains a big uncertainty. But I think the signs are there that, you know, both eventually the US and Iran will have to seek some kind of compromise, maybe not the kind of compromise that the markets will be completely happy with, but something that will work and perhaps kick the can down the road. And that may be enough. I think the key thing markets are watching out for is the Strait of Hormuz. And what's interesting, and I've been reading articles on Bloomberg in the last 24 hours, and we are seeing traffic slowly return to the Straits of Hormuz, with Iran saying that, you know, more than 30 vessels had crossed the Strait of Hormuz in the last 24 hours. So that's a positive sign, the way I see it. I mean, we're not going to get a perfect solution, but we may get something that will be enough to satisfy the markets.
And yet, regardless of what happens with the war in Iran, you still like the likes of Hong Kong and China. And we've seen this incredible optimism around potentially Huawei talking about this new way to really close the gap with TSMC. How much more potential is there in that sector?
Well, you know, I think there is potential in the technology sector, in the AI sector. In fact, when it comes to China, when it comes to Hong Kong, I think one of the reasons why we're optimistic is also because, you know, you are seeing Chinese and even, you know, to some extent Hong Kong companies catching up with some of the major hyperscalers, the big tech companies in the US. The gap is slowly narrowing. And so China is not just about a domestic demand story, but also about an innovation technology story. And that's one of the reasons why we like China and Hong Kong. And we remain positive. I mean, the valuations are not expensive, and China has a lot of firepower. They've got a very strong balance sheet to support the economy. They've got a huge stockpile of oil and energy reserves. So, the list goes on. You could come up with several reasons why one can remain positive on Hong Kong and China for the medium term. But clearly, as you mentioned, technology innovation is one of the areas that, China is quickly catching up on.
And not to mention, I guess, the relatively successful way that it's been kind of shielded more than most economies from the ongoing energy crisis, right? Are there other specific sectors that you like when it comes to Chinese equities?
Well, I think when it comes to Chinese equities, domestic demand is clearly a factor in as far as China is concerned. I think, the internet companies in China are clearly beneficiaries of that domestic demand. And the Chinese government is quite intent on, boosting domestic demand in a world that's very fragile and fractured. I think, we've got a huge Chinese population with a huge amount of savings, but a very cautious Chinese consumer. And I think the government is trying to inspire confidence, domestic tourism, domestic industries that will, essentially propel China in the next decade or so. So I think looking inward is also important. Industries in China that will benefit from the government's push towards domestic demand.
Looking outside China, and obviously you've talked about that preference for the A-share market, do you think that anchor to emerging market equities or emerging market assets in general still weighs here? And are there opportunities for Asia EM, despite, of course, some of the sort of ongoing pressure on the energy front?
Well, clearly Asia is feeling the pressure from what's happening with the energy sector. But what's interesting is at the same time, when you look at Asia ex-Japan within the EM space, it's actually outperformed on a regional basis compared to the US, Europe, and even Japan. So if you pick the MSCI Asia ex-Japan index year to date, I think it's up more than 20% the last time I looked. And of course, a lot of it is coming out of South Korea and Taiwan, but other markets have not done as well. But, we see a lot of potential and opportunity in this space because, I think if things in the Middle East, improve, if the situation in the Middle East improves and oil prices come off, clearly Asia is going to be a big beneficiary. Asia has been impacted by the higher oil prices. So if that concern slowly recedes to the backdrop, I think that's going to be very positive for Asia ex-Japan. And not just China and Hong Kong, but other markets like Singapore as well.
Yeah, I'm glad you mentioned Singapore because it's obviously overtaken Indonesia in terms of the size of the market. It's clearly a market that's benefited from sort of the relative economic and political stability. Is it an interesting market for opportunities to you?
Definitely. I think if you're a medium to long-term investor, you cannot ignore Singapore. Singapore is seeing, in some ways, a revival or a re-engineering of sorts. In the last couple of years, the government has announced several initiatives to, boost the Singapore stock market, and the government is putting money where its mouth is. It's given a lot of funds out to global fund managers to invest in Singapore, to attract money into Singapore stock market. Valuations are not high in the Singapore stock market. Dividend yield is very attractive in Singapore. The Singapore government has an extremely strong balance sheet, to support the economy. And again, the list goes on. But I think the key thing is that, the government now seems intent on boosting the Singapore stock market as a capital market in the region, and it's doing it quite successfully. And it's dishing out quite a lot of money to do it. A lot of changes in terms of corporate governance and other capital market reforms. And all this will play out over the next 3 to 5 years. And so clearly, I think global investors cannot ignore the Singapore stock market within Asia ex-Japan.
Which is sort of the narrative that we've seen play out here in Japan as well, right? When it comes to corporate governance reforms and really capital markets being the focus. Is there still more leeway for gains in this market? And has Prime Minister Takaichi done enough to allay market concerns about her new budget? Well,
I think Takaichi has been good for the stock market. She's pro-growth. At the same time, she's in a way watching the Bank of Japan very closely, and the Bank of Japan is also taking its cue that it doesn't want to increase interest rates too dramatically. I think the Bank of Japan will have to hike rates, but we're not talking about dramatic rate hikes coming out of the Bank of Japan. I think Takaichi's good relationship with world leaders, along with the budget, along with the BOJ not being too aggressive in terms of rate hikes. And as you mentioned, the reforms taking place in Japan have clearly come through. I mean, if you look at Asia year to date, aside from South Korea and Taiwan, the Japanese stock market has also done exceptionally well, in US dollar terms. So, clearly it's a market that investors cannot ignore. We are neutral on Japanese equities. We're not underweight, we're neutral, and we think that, there are opportunities in Japan.
Vasu, where do you stand on traditional safe haven assets like gold and the US dollar?
We are positive on gold. We think that, in the short term, gold is going to face, potential headwinds because of uncertainty with regards to interest rates, global monetary policy, what's happening in the oil markets in terms of, the potential for it to fuel inflation. So gold has been treading water, but our view over the next 12 months is that gold could potentially escalate to about $5,500 an ounce compared to where it is right now, which is $4,500 an ounce. Our view towards the US dollar is one where we think that, the dollar is currently strong, relatively strong, holding up fairly well. But we think that over the next 6 to 12 months, the dollar is likely to weaken as tensions in the Middle East ease and, markets become more risk on. I think that's going to weigh on the dollar. Not because the dollar fall off the cliff, but we see the dollar actually weakening against most major currencies, including Asian currencies. And, that's going to, again, be something positive for gold because gold is priced in US dollars. It becomes more affordable when the dollar weakens.
Vasu Menon, always great to have your insights, Managing Director at OCBC. And these are some of the stocks that we're following, especially in the Korean session. Do watch out for SK Hynix, where we're seeing gains of almost 4%. Bloomberg Intelligence now saying that its earnings outlook is strengthening. We're seeing rising AI demand fueling that high bandwidth memory super cycle. The consensus also has revised EBITDA forecast upward for SK Hynix. And broadly speaking, we're following the tech sector, especially with the robotics gains that we continue to see across Asia. Of course, we are talking about the likes of Hyundai Motor, but we also saw Yaskawa here in Japan, for example, flying in the previous session on their medium-term update. More ahead, this is Bloomberg.
Well, the US military says it's carried out what it calls self-defense strikes in southern Iran, including on missile launch sites and boats placing mines. This comes just hours after President Trump said negotiations with Tehran over a deal to reopen the Strait of Hormuz were proceeding nicely. Let's get to our Bloomberg editor, Michael Heath. I mean, I don't purport to sort of know what military strategy involves, right? But these two things would seem to be at odds. A bit
contradictory, yeah. I think, Haidi, that basically Iran was looking to lay mines in the Strait of Hormuz, which the US has always, and most nations have been very, very worried about just because of the risks that they pose to commercial shipping. So the aim was to sort of prevent that. There's been these spot fires going on non-stop. I mean, over on the border with Israel and Lebanon, there's quite a lot of fighting going on at the moment as well. So whether this is enough to sort of derail where talks are or not is hard to know. It seems unlikely. There does seem to be a lot of momentum going on. There's talks going on in Doha at the moment. Iran's parliamentary speaker has been there. Pakistan's military chief is going over there as well. And as President Trump said in his message, that things seem to be proceeding proceeding nicely. I'm sure that might be a bit over the top, but nonetheless, there does seem to be a bit of momentum. But it's impossible to avoid these spot fires too, just because the nature of Hezbollah or the Iranian Revolutionary Guard Corps, Islamic Revolutionary Guard Corps.
Well, it's interesting because Netanyahu spoke with Trump, and his takeaway from that was the reaffirmation of Israel's right to defend itself against threats on every front, including in Lebanon. Does that make Hezbollah being a part of the draft agreement, which we expect that it is, ineffective, if not sort of impossible?
Well, it's hard to reconcile because there has actually been a truce between Lebanon and Israel, but which Hezbollah and Israel have both been, there's been intermittent fighting that's gone on there. But you're right, Iran sort of has been very clear that no deal if Hezbollah is not included, and there's a ceasefire there. By the same token, Prime Minister, as you mentioned, Prime Minister Netanyahu spoke to President Trump and said we must have freedom of action to defend ourselves, and Trump has sort of said yes, that's fine. So it's very hard to know whether they'll fudge that, whether they can reconcile that. There's a bit of nervousness, it seems, in Israel about just how involved they are in this whole peace negotiations. It's slightly separate, but there's a lot of bits to reconcile that are very difficult, as this morning has just shown with the recent events.
He's also, again on Truth Social, said that he thinks the enriched uranium will preferably be destroyed in Iran or at another acceptable location. Do we know if this is sort of the case in terms of what's been agreed?
Look, it's difficult. There was an Al Arabia report that was saying that Iran wants China to take the enriched uranium, which probably wouldn't. I suspect that the US would be okay. That's a hunch. That the US would be okay with that, rather than it perhaps going to Russia or somewhere like that. That China has generally tried to be a fairly balanced, neutral cop in this sort of situation. So that might be one option, though. President Trump was saying either it comes to the US or it's destroyed on site in Iran, which that would be his preferable option. But again, there's a lot of horse trading going on, and just we haven't even got to whether Iran can keep enriching or any of these other nuclear things. There's just so much to tick off. Even just to get this extended truce is looking like a big mountain to climb. But there does seem to be quite a lot of will there that people don't want to go back to war. So hopefully they can manage to do this.
Michael Heath, a Bloomberg editor there with the latest on the Iran war. Now, the number of confirmed Ebola deaths in the Democratic Republic of Congo has now topped 200, raising fears of a wider regional spread. Let's bring in Bloomberg's biotech, pharma, and healthcare senior editor, Jason Gale. Jason, how contained is this outbreak?
Well, it's not. Unfortunately, the virus continues to run ahead of containment measures. Yesterday, the World Health Organization Director General said, and I quote, "We are now playing catch up with a very fast-moving epidemic. At the moment, the epidemic is outpacing us." And that really sums up what's happening. The latest from the Democratic Republic of Congo, where they've reported 101 confirmed Ebola infections, 930 suspected cases and 221 suspected deaths. That's according to the Health Ministry. Uganda yesterday reported 2 extra cases, bringing their total to 7. So this is a fast evolving situation and continuing to worry people.
There's also no vaccine, and I assume no sort of timely ability to develop a vaccine that would be helpful, right? Is that part of why the containment measures are so difficult?
It's difficult because of a number of factors, one of which is the strain that you just mentioned. Bundibugyo is the strain that's causing this outbreak. There are no proven vaccines or treatments, specific treatments for this one. So that has made it very hard. It was initially very difficult to detect and to know that this outbreak was going on. But this outbreak is occurring in an area that is a conflict zone. A lot of displaced people. There's a lot of mistrust in health professionals, the health system. And in fact, a survey by ActionAid found that 1/3 of people in the main province affected believe that Ebola is not true, that it's not a real thing. So they're up against a lot of challenges with this one.
So what can health authorities do at this point, and how much of a broader threat is this to the entire world?
Well, at the moment, it's a regional threat. The World Health Organization has said that the risk in the DRC is currently very high. It's high in the 10 neighboring countries around the Congo. But for the rest of the world, the risk is low, according to the WHO. Right now, the challenge is to build community trust and awareness of what's going on so that the health workers who are trying to identify and isolate cases can do so safely and effectively.
Bloomberg's biotech, pharma and healthcare senior editor Jason Gale in Melbourne with the latest on that Ebola outbreak. More ahead on the Asia trade. This is Bloomberg.
And the top corporate stories that we're tracking, the Shanghai Stock Exchange says it will hold a meeting next week to review the IPO application for Chinese robotics startup Unitree. According to its prospectus and released in March, Unitree was planning to raise about $620 million with a listing on the Star Board. It said the proceeds would fund research into AI models for robotics, develop new products, and expand manufacturing. BHP has reportedly pulled back on key decarbonization projects in its West Australian iron ore operations. According to leaked internal documents cited by The Guardian and ABC Television, the company last year shelved or deferred solar, wind, and battery projects. A BHP spokesperson says many technologies the mining industry needs to achieve net zero are not yet ready to deploy. One of Samsung's smaller unions is reportedly seeking to halt a vote on a tentative wage agreement between the company and its largest union. Yonhap says the union representing non-semiconductor workers plans to file an injunction with the Suwon District Court today. The tentative deal Samsung struck last week staved off a potentially catastrophic strike. And of course, we know that that tentative deal would give about $400,000 for employees of the booming memory chip division. But at the same time, that would be a 100-fold gap with employees elsewhere. So we continue to see this point of friction even within Samsung that we'll be watching in the South Korean markets. Of course, Samsung and SK Hynix make up about 40% of the Kospi. And you're seeing right now the Kospi play catch up to those gains earlier in the week. Remember, it's coming back after a holiday on Monday. The Korean won still pretty weak against the US dollar, despite the fact that we have seen a little bit of weakness and stalling on the greenback. We're seeing the Korean won trading at that 15-14 level. And Haidi, will continue to watch the volatility perhaps in the South Korean market because also we are expected to debut their first ever single stock leverage ETFs this week linked to Samsung and SK Hynix.
Yeah, and of course, we are seeing that rally when it comes to US treasuries across the board. And outside of that sort of tech enthusiasm that you speak of, there is that optimism that we continue to see perhaps some progress in the right direction when it comes to the US and Iran. We're seeing that really across the curve rally there for treasuries, cash trading resuming after the holiday break for Memorial Day, investors getting more optimistic about the potential geopolitical situation improving. We're seeing yields and that 2-year falling, the 10-year also dropping around 7 basis points there. 30-year yields also trending in the same direction as well. At the same time, Brent crude futures sliding more than 7% on Monday. We're seeing a bit of volatility, though, when it comes to trading in oil, with some of those prices starting to pick back up. President Trump saying that the talks to extend that ceasefire proceeding nicely. This is Bloomberg. Take a look at oil at the moment as we continue to monitor these geopolitical developments, of course, ongoing with the talks between Iran and the US are proceeding nicely, according to President Trump. At the same time, we've seen some further developments when it comes to the threat of re-escalation of military operations as well, with these explosions being reported from coastal cities in Iran. Brent crude at the moment, this is the picture as we switching out the board to take a look at New York traded crude. We're still lower by just about 5.5%. Also watching gold at the moment. We've kind of turned around when it comes to gold pricing. We had an earlier gain as we see that progress kind of on the geopolitical front, easing the broader inflation concerns, but we're continuing clearly to monitor for further developments. A bit of upside in the trading of copper at the moment, higher by about 0.9%. That metals climb has really been an interesting one, given that we've had the war shocks colliding with a broader boom in AI demand. And as Asian energy markets grapple with the Strait of Hormuz closure, traders are fixated on the weather. Summer forecasts pointing to higher than normal temperatures across Asia, which is set to strain power grids. Let's bring our Asia energy and commodities editor Andrew James. So what is going on that could potentially make the whole supply and demand situation even more complex?
Hi, Heidi. Yeah, well, I mean, despite we've had a fifth of global gas output trapped behind the Strait of Hormuz, but we haven't actually seen extreme price spikes as we've seen in previous energy crises. There's a couple of factors that could change that in the coming months, though. We've got forecasts pointing to higher temperatures in Asia over summer, and that could be exacerbated by an El Nino weather pattern. What happens to China demand? I mean, is the big question. We had reasonably weak Chinese inputs in March and April, but that's already starting to change. We've seen a couple of cargoes that had been on their way to Europe divert back to Asia. And the risk is that we get sort of strong demand in Asia, and then we get that sort of competing with Europe, and then we get in a race in which prices get pushed higher and higher.
Yeah, I mean, here in Japan, also a huge LNG importer. I mean, we are seeing incredible heat already, and the summer hasn't even properly started. What are we seeing so far when it comes to LNG flows?
Yeah, well, as I said, we're starting to get some cargoes divert back to Asia. Japan is another big factor. It of course, is the number 2 buyer after China. And the situation in Europe as well. We've got low hydro river levels in Europe. That could also affect nuclear. So all in all, hot summers, it's going to really push up prices, potentially both in Asia and Europe.
Andrew James, Bloomberg Asia Energy and Commodities editor, as we continue to follow the repercussions from the ongoing war in Iran. And Asian and EM currencies in focus as market optimism for a deal drives the dollar lower. That move pushing the onshore yuan to its strongest level in over 3 years. Let's bring in Bloomberg FX and rate strategist David Finnery. David, so with this broader global risk on sentiment, we have seen, of course, the reaction in currency markets. But China has its own idiosyncratic news around capital controls.
Yeah, certainly there was news coming out that basically they're clamping down on some of the moves, shall we say, some of the equity moves, some of the flows. But so far the market's basically sort of shrugged that off. I think the general trend at the moment, the market really is so heavily focused on the US-Iran war that basically whatever headlines come out of that sort of tends to dominate anything at the moment. So even though that China news did come out yesterday and over the weekend, the market so far said, look, that's okay. The yuan fixing yesterday was slightly stronger from the yuan perspective. So if that's the case today, the market is going to say, well, okay, well, look, PBOC is signaling it's content with a stronger yuan. The positioning's certainly been for a stronger yuan in terms of hedge funds and real money positions, so they'll quite happily go with that trend. So at the moment, as long as they see things going a stronger yuan, they're quite happy to ignore the rest and just focus on the positives, shall we say.
David, where do we see the story of dollar strength headed if there is a sort of enduring peace?
Yeah, I think the knee-jerk reaction, I think, if it was an enduring peace, then you'd have to go back to what was before the start of the war, and that was basically the market sentiment was sell the dollar. So I think you'd have to go back logically back to that market sentiment, returns to that. The question is how much you sell the dollar. I think that comes back to how quickly can the market price in rate cuts? At the moment, the market's looking for a Fed rate hike this year. But again, if the data starts coming in weak, suddenly they go, oh, okay, no, cuts are back on the table. Then I think they'll they'll quite happily sell the dollar if they get a chance. The question really becomes, after those sort of knee-jerk reactions lower, how low can it go? Because I think at the end of the day, if you look overall at the US economy, it's actually performing not too bad, I apologise. And certainly compared to, say, the Euro economy, which is struggling a bit more. So on a growth dynamics, you could go, well, actually, the US is not doing too bad. So I think there is downside for the dollar because the market's is biased towards selling it. But I think the downside will be a bit limited, shall we say.
Which is why we've seen Treasury yields to really rally to multi-year highs. Although in today's session, it seems that we're seeing a little bit of relief when it comes to Treasuries coming back, rallying across the curve on this expectations that we might get that deal with Iran.
Yeah, I think the market's very fickle at the moment and very sensitive to any news. So anything that's positive, the market's quite happy to go, oh, we've actually gone too far in hike pricing. We've gone to, the yield's now looking quite attractive. So you're seeing buyers coming in. So I wouldn't be surprised if you get more positive headlines, you get more of that sentiment of going, look, actually, we've just gone too extreme on our pricing for hikes. So I think some of those will get dialed down a bit. Again, how much they get dialed down really does depend on the data that comes out. I mean, you certainly, next couple of weeks, you have US payroll data, which will be very key indeed. And let's say, hypothetically, that comes on the weak side. So markets will very happily price go, we've gone way too high. Hikes, they had to price in, redial that back, and you'll see treasuries push down. So between the news, positive news is sort of good for treasuries in terms of moving, yields going lower, and what the data comes out as well. So I'm not surprised at this level. It's one of those things where they go, when they're going higher and higher, markets going, oh, they don't look attractive. And then all of a sudden they go, oh, actually they're very attractive because the data's coming weak. So, the market can change its views very, very quickly indeed.
Bloomberg FX and rate strategist David Finnerty there. Well, coming up, Australia's government facing a backlash over its budget changes to capital gains and investment property taxes. We get more next with the CEO of the Policy Institute of Australia. This is Bloomberg. A recent poll suggests that Australians broadly expect the Labor government's latest budget will leave them worse off. Policy changes, including a clampdown on tax breaks for housing investors, as the government seeks to address intergenerational inequality. The government is also consulting with small businesses over planned changes to capital gains tax discounts. Almost 40% of respondents to the news poll say they expect to pay more tax overall, suggesting efforts to sell the budget have, at least with some of these demographics, fallen short. Joining us now is Amy Auster, who's the CEO at the Policy Institute of Australia. Amy, great to have you with us. And we were talking about this a little bit earlier when it comes to addressing the affordability crisis when it comes to the property sector in particular. These policies are intended to create a redistribution when it comes to the housing market. Do you think that is, a needle that is possible to be threaded, or do you think what we're going to end up with is going to be that uneven slowdown in the property market and perhaps not as much in terms of addressing affordability and accessibility?
Those are great questions. Good morning. Great questions and a complex series of questions. So I think in this budget, the changes that we've seen to tax have been oriented toward improving the equity and ensuring the progressivity of Australia's income tax regime. And that's really where the conversation started. In terms of the tax changes themselves, I think the application of a change to the CGT discount as it comes to property really wasn't a surprise. That's something that the government's been telegraphing for a while and has done some work on, including through a special Senate committee that was convened to look at this tax. What did surprise people was its broader application across kind of any capital gain, which affects small business, medium businesses. It affects the startup and venture capital sector quite dramatically. And that's where, if you like, there's now a lot of work being done to figure out how to take that one forward. And I think we'll see, further discussion as the legislation gets released this week. In terms of the impact on the property market, there's been some modeling done. A few caveats I would say. One is there's a lot of things happening in the property market right now, including we're still in a rate rise cycle. The RBA has just raised interest rates again, probably on hold for now, but with the economy slowing in a higher rate environment, that's going to have an impact regardless. And the changes in the tax are grandfathered, so any existing property is going to be managed under the old arrangement. So in terms of practical impact, it's more about expectations going forward than, if you like, immediate impact now. That being said, the models indicate, not a huge impact in terms of either the turnover of property or on prices of property. It's more the mix of investor properties versus owner-occupied properties. For me, I think, as I said, the impact is probably relatively muted. And for us, Policy Institute Australia, what we wanted to see in this budget was more effort on the supply side to create more housing supply, because at the end of the day, that's really what's going to balance the scales in terms of people having access to the homes that they want to purchase.
Do you worry about the sentiment impact? Because as I think you alluded to, this sentiment shift in property started before, obviously, the global developments of this year, right? And certainly before the budget with the tightening cycle of the RBA. Do you think now that, given we still have potential global shocks on the horizon as well, that it has become a bit more risky in terms of that erosion of accumulated wealth in this country that is tied to the property market?
You hesitate to bet against the property market in Australia because it's been so successful for so long. We say the property market, there's actually a lot of nuance in the property market. Detached dwellings tend to perform better over time than units, for example. There's some great variation in price performance there. And we've been through periods before through either rate tightening cycles or when APRA has tightened up credit metrics, which kind of has the same effect, where we've seen prices track sideways for a while, and then situation improves and prices start to rise again. We very rarely see prices decline. What we do see is when conditions are not good or when sentiment is weak, what we see is volumes drop, because owners don't want to sell at a discount. So what we tend to see when sentiment is weak is that prices track sideways and volume drops. And I think that's what we might see in the current environment.
Amy, when it comes to international investors watching this budget, is the budget, does it signal a more open Australian government to foreign investments, or could it be more disruptive?
Well, in fact, there was some really good news for business in this budget. The debate domestically has certainly been very focused on the tax changes, but there's been other things going on that are quite positive for foreign investors. In particular, I would call out there's a bit of investment going into Treasury to look again at how they are approving applications that go through the Foreign Investment Review Board. Now, that's the FIRB has been reformed to take a greater look and scrutiny some years ago at foreign applications for investment that were coming through. A lot of those have to do with commercial property. The process now, or the reform, is to speed those up with a commitment to a maximum 30-day turnaround time and to streamline approvals, which really should be beneficial for foreign investors in particular. There were also a number of other measures that we've been advocating for to basically improve regulatory practice, deregulate, streamline approvals, streamline tax compliance, including with the ATO. So those are all really positive for investment, and that continues on work that the government was doing in the first term to lift productivity through improving competition. That's something that we've really advocated for. So there is quite a bit for business to like in this budget, while we are also grappling with these CGT changes.
Tell us a little bit about the productivity reform, for example, because, of course, we have been looking at this budget from the tax lens, and it's a huge change, but at the same time, how much did it do in order to really address those structural issues in the Australian economy?
Well, this is one of the things that there's a couple of, if you take a step back, there's a couple of things that I think are really commendable in this budget. One is, and this is really important, one is that it has stabilized the deficit, it has stabilized the size of government as a share of GDP. It's a much more expenditure restrained budget than what we've seen from this government in the past, including taking on the cost of the NDIS. So those are really good signs for, if you like, overall budget and fiscal management. So I give that a tick. The second is that if you read the budget papers, there was as much space given to productivity reform or reforms oriented toward lifting productivity as anything else. That's not something that we've seen in budgets for a long, long time, and that is really positive. So there were things around occupational licensing and faster and better use of the skilled migrant visa. So we have a lot of skilled migration into this country, but because of the point system, it's very complicated. People often end up working in jobs that are not where their skills sit. And so reforming that and making it easier for people to get those high-value jobs and migrants who are coming to Australia, very positive. They're making standards free through Standards Australia. Sounds like a small thing, but when you're an electrician and you have to pay $1,600 just to figure out how to comply with the code every year, that's productivity enhancing reform. There's a lot of these things that are kind of, they sound micro, but you add them up and they do lead to an improvement in productivity by just making it easier to do business in Australia. So there's stuff that was done. We have a wish list of more things that we would like to be done, especially housing planning, land release planning, zoning approvals. That's something that could really boost housing supply and efforts to improve productivity in our construction sector, really important for housing. But there was some really good progress made.
Given the public's response, does the government need to do more in order to sell this budget, and will it make a difference when it comes to implementation?
It's a great question, and I'm not a politician and it's not up to me. I think there's going to be a lot of education that's going to be needed. The legislation on CGT is coming in this week. We'll see how that gets debated through Parliament. Trusts, which is also really important for business, that's not coming to legislation until later this year. So there's quite a long way to go and conversation for people to understand what the changes are and what it means for them. So I think this will take some time. What's hanging out in future, of course, is that the measures as they're being contemplated right now are revenue raising. The government has introduced the working tax offset, the WATO, $250 reduced for anyone who's paying income tax based on a wage. Going into the next election, there would certainly be room to expand that. And so people may find that, there is a good deal for them in the end in these tax changes, but we just have to see how it unfolds.
Amy Auster, CEO of the Policy Institute of Australia. We do have more on Australia Ahead every Tuesday at 10:40 a.m. if you're watching in Sydney, 8:40 a.m. in Hong Kong. You can tune into the Bloomberg Australia podcast too, delving into the biggest stories shaping the country's role in global business. Find it on Apple, Spotify or Bloomberg.com. This is Bloomberg.
Chinese chip stocks surged after Huawei said it's come up with a new way to shrink its gap with industry leader TSMC. That could allow it to fabricate advanced chips without needing cutting-edge equipment made by ASML. Lianting Tu is our managing editor for Asia Equities. And Lianting, we're seeing the big market reaction. It's quite significant for the broader industry as well.
Yeah, investors are really taking that seriously. As you mentioned, the market jumped yesterday in mainland China, and that showed investors are taking it as a potential breakthrough for China's chip self-reliance ambitions. What really matters here is that the global assumption for the industry is any advanced chip making would rely on ASML's EUV machines, which China can't get access to. But if Huawei can genuinely narrow the technological gap without using the machines, and that really challenges the underpinning assumptions for the chip industry globally. So yeah, I think that's definitely very positive. But the caution here is that Huawei's roadmap for this technology rollout stretches into the next decade, and mass manufacturing advanced chips is extremely difficult. So there's definitely a little bit of caution that investors should take into consideration as well. But I think in the meantime, in today's market, you're probably going to see a lot of chip rallies in Hong Kong when it reopens.
We've got Hong Kong markets reopening today. China's crackdown on cross-border stocks trading, is that set to be still in focus?
Yeah, I think the initial panic has really faded over the last few days. And as investors digest the news, they realize that the 2-year time frame the government gave to unwind those shareholdings in Hong Kong stocks is actually a relatively long period. And it doesn't mean the money is going to vanish. We have reported that people are really looking for workarounds, which means some of them are putting into brokers like HSBC and Bank of China Hong Kong branch, where such trading is still allowed, and some others are putting into more safer channels such as QD funds and Stock Connect. So yeah, I think people are going to take it still negatively for Hong Kong's market. For broader market today, I think tech is probably going to dominate.
And given the dominance of tech, of course, we have seen the big divergence with markets like India and Taiwan surpassing it.
Yeah, it's a huge divergence of fortunes, as you mentioned, between markets like Taiwan, which has a lot of cutting-edge AI technologies, and markets like India, where it doesn't really have AI export, but is heavily reliant on oil imports. So we're seeing the kind of the divergence playing out, and now Taiwan has overtaken India as the world's 5th largest stock market.
Bloomberg Managing Editor for Asia Equities, Lian Ting Tu. We'll continue to watch these Greater China markets, with Taiwan's market cap rising to $4.95 trillion, overtaking India.